Welcome to Total Money Management. I'm throwing remotes around, putting my coffee down. We've got a bit of a special today. Tom's back.
Drum roll.
I'm back.
Tom's back. Where have you been, Tom?
Did I ever go?
Have you been procreating?
I have. I had a kid. I had a break. You guys were stressing me out.
Tom is Australia's equivalent to Elon Musk. Let's have kids.
What's that? Your 10th now?
Mate, I don't know. Must be getting close.
What number are we up to in the alphabet?
There's a few.
Aaron, Bobby, Charles, Donald, Elon.
No, it's good to have you back,
Right,
mate. Steve's been grinding me for at least 3 or 4 months. So
Now I'm just shoved in the corner like an old man. Right.
We can share the frustration.
Don't listen to the old fella in the corner either.
Oh, let's Steve. I've got a photo of you.
Here I am.
Steve Munger.
Here's me in 10 years.
Oh, mate, it's good to have you back. So this week we're covering 21 to 25 April. This is my words, we're in a bit of a suck it and see moment with the tariffs and all sorts at the moment. So it'll be good to just go into a few other things. We've got some things coming up on buy low, sell high. We've also got a bit of an overview on the tariffs as well. So
It's all tariffs. Goddamn sick of hearing about tariffs.
Tariffs, US, China.
Oh,
A
God.
lot of volatility in the
you haven't
environment.
missed much, Tom. It's still China. It's still EVs.
Still Steve raving on about an expensive property market. What else do I rant about?
Hopefully you don't offend too many
Feminism.
people.
Feminism. That's
Yeah,
it.
yeah.
Yeah. Okay.
You're banned. You're banned from talking about that.
Yeah. I'm
No,
not-
you're gonna offend.
no more talking about the old days.
He's got a written
Right.
apology from last week.
Anyway,
Right.
take us away. Let's get serious.
Yeah, well, look, volatility we often talk about as a negative thing, right? Whenever something's volatile, things tend to be uncertain if you don't have the right strategy. At the minute, we're in a very volatile period.
Yeah.
Well,
yeah.
People only talk about volatility being negative when they're losing money.
Yeah.
I can tell
No
you
one
now.
complains about the upward volatility,
No.
right? When it's climbing at 15% per year.
When we're in Bitcoin and it's having a tear. It's
Yeah, you don't
exciting.
go, oh man, this is like really volatile.
100%.
I should do something.
Yeah.
Maybe you should take some money off.
Oh, mate.
But it's true. But the thing there is, and in all seriousness, it is a really big competitive advantage if you can stay sane when everybody else is going crazy. And that's what we sort of talk about a lot with systematic investing, is saying to people, listen, keep your head, right? It'll be all right. And again, it runs off a whole raft of things, which is, don't lose money. Make sure you've got a cash pile there. Make sure you're rebalancing. Make sure your asset allocation's sensible. Don't be too greedy. Don't be too fearful. Take time out between panic selling, like, oh my God, it's all terrible, I'm going to sell. Just, check, like have a sort of mental checklist. And as I was saying to someone during the week, look, it's not easy, and even I'd still go, oh my God, but I'm old enough now to and experienced enough in investing to say, okay, let's just chill out a little bit. And there have been days, not so much recently, but in a few years ago, there were days where it was, like, oh, the market's going to be slaughtered today. And I thought to myself, okay, just don't look at the stock market today, right? And I would do that. I'd just go, okay, just don't look. Because you don't want to open up and go, oh, my portfolio's down 100 grand. Oh, cool.
How
I'm just not
easy
going to
is
have an emotional reaction.
How easy is it to look, though?
Well,
man.
It's on your
yeah.
phone.
It's hard not to look when the day starts off, you're 12 grand down, and
Yeah,
you check
yeah.
three hours later, and you're 18 grand down, and you're like, this is horrible. But, like, I must say, I think we were lucky that we've been, involved in high volatile instruments for a little while now. But that day a few weeks ago, I will say that was a tester.
Yeah,
And that was a testament to having lots of cash, rebalancing.
Yep.
Brought my average purchase price down a lot.
Yep.
Like the stock hasn't recovered, but I'm in the green.
Yeah.
But that's what I mean, Tom. It's the beauty of rebalancing, but it's also the ability to say, the blood in the street stuff, right? Where you look at it and go, oh man, this is awful. But you actually say, yeah, but if you buy now, because we know the volatility clusters, you'll probably be good in 2 weeks. Like this week, right, the US market went up 4%, right, in a goddamn week, right? It's had 3 days where it's been over, I think it was 1% or 2% or something, right? And then last night it closed up again.
Oh, the intraday swings have been huge as well. Like
Absolutely, mate. They've been mammoth, right? And I will tell you, that will scare the shit out of you because you just look at it and it's something you don't get in a lot of asset markets, right? Bonds don't usually do that. Property, you don't wake up and go, oh man, my property's down 12%, right? You just don't get that same experience. And that's what makes stocks a bit different. You've got that really big volatility. And, that's where it makes it really hard to manage your emotions. And that's why we say to people, let's talk about your personality and let's talk about, groupthink and a strategy. And if you get those three aligned, you'll be fine.
Yep. I mean, look, saying that, the US has had the best 15 years in its history.
Yeah.
And this volatility could either mean that we may be heading to the downside for the next few years, or it may just be a short volatile period and it continues up, which we think is probably less likely.
Unless, of course, you go into leverage long ETFs.
Which seems to be...
Everyone piling back in again.
Which is fun when it's going up.
Well, I still think we're at the start of a bear market rally, of a longer bear market, right? Like we were talking about there at the coffee shop, the tariffs are they're not that big. At the moment, all the talk about tariffs is what the impact will be, right? And there's plenty to talk about on that. But like you said, Tom, it's not here yet.
Yeah.
Right?
We're yet to feel the full
exactly
impact
right.
of this, yeah.
Yeah. When it hits, that's when markets all go, uh-oh, this is the real McCoy.
Yeah. We thought cost of living was bad. Before tariffs.
Yeah. That's what I mean. Wait till the tariffs come in and then, you ain't seen nothing yet, baby.
Yeah. Well, I mean, is there any world where the impact of the tariff is actually positive for the economy, do you think?
Well, again, it depends. Like when we did the special a couple of weeks ago about tariffs, in every market there's winners and losers. Right, and you've got to sit down and figure out who the winners are and who the losers are, right? So if you look at, and I haven't put it in, I'll put it in next week's, the week that was, but I clipped a chart yesterday which showed that in these types of environments, going short, right, having put options, which we've been talking about, hedging, right, and gold, right, really do well over a decade where there's high inflation and stuff like that. So,
not advice.
Not advice, but that's what we've been talking about for a while, right, about hedging because it's going to be volatile. And if you look at history, gold does really well when stocks are high, blah, blah, blah. So that's you as an investor, the older I've got, the more agnostic I've got in terms of the economy, in terms of saying, oh, this could be really good or really bad. As an investor, I just look at it and go, okay, where do I make money? I mean, I know that's rude and brutal, but that's the way it is. You've got to look at it and say, okay, gold. Okay, gold, fine. Okay, yep, that's the way it is.
Gold's
all right,
cheap,
well, I'm going into gold.
Yeah, emerging markets are cheap. Let's have a look there.
Absolutely.
It's part of the strategy. If you're looking at it emotionally and you get tied to something, that's where you get burned.
Yeah, absolutely. But it's impossible when you're trying to make predictions. The best thing, the more you want to know about the future, the further you should look back, right? Because as I was saying to you, Tom, before, it's all about cycles. There's nothing new under the sun. It's always just about cycles. And that's why Warren Buffett is really good because at 95, he's been through lots of cycles, right? And so he's got all that built up history. Whereas if for you guys and younger, it's a lot harder because you haven't experienced it, right? And that's the old stuff about the old guys telling the young guys and handing down the experience because it just keeps repeating itself.
Yeah, fool me once type stuff.
Well, a little bit, Jacob, but it's just about, the hard part about being young and what I talk to people about with investing is it's really easy to get it from the neck up, right? Like to get it logically. Oh yeah, the market goes up and it goes down. Cool, okay. But to get it in your soul, like in your body, that's when it's really hard, right? Because you go, oh yeah, like you said, Tom, like, oh, market's gone down 12% today. Oh, that's interesting. Holy Jesus, right? You know what I mean? Like you're not like me where you go, man, 12%, I might start buying some.
Yeah.
Completely different reaction to the same event. And the difference is I'm 62 and you're 30.
Oh, right? I can tell you now, like we've done this at a smaller scale, very comfortable with it. That definitely was a tester. Like when you see your portfolio down that much in a day, and then the system says, all right, we're buying lots of this stuff right now. So you're going, hang on, I'm already down a lot. And I'm going to throw more in. But that's where you trust the system, right? And that's how you go through a cycle and learn from it.
Yeah. Well, I think I said a few weeks ago, I'm not sure, but there was one line I read in a book, and it's in Jeremy Siegel's Stocks for the Long Run, right? And the guy said, either we have chaos or we have recovery. And clearly if we have chaos, well, nothing holds its value. Gold, Bitcoin, stocks, it just all goes to hell in a handbasket. Okay, well, that's probably not going to happen. Okay, well, we have recovery. Oh, okay, well, if that's the case, then actually I should probably buy some stocks. You know, and then as Jacob said, you go, okay, where's the cheap stocks? Emerging markets. Okay, well, maybe I should buy in emerging markets.
Yeah.
Right? It makes complete sense. But when it happens, like you say, Tom, when it happens, you're biting down your fingernails and thinking, oh, man, this is the end of the earth.
What have I done? I made a mistake.
Yeah.
That old crocodile brain comes in. It's like, fight or flight, fight or flight. All right, let's talk about China. So Steve, we've been talking.
Too long.
We've been talking about this for a long, long time, but this is quite interesting because they're starting to withhold or start to mess with the supply and demand on rare earths. Yeah. So that's obviously your wheelhouse, but it's happening now where they're going, okay, well, we're going to withhold exports of rare earths that whatever they're doing in China. I mean, I don't actually know. Will they clean them or something?
Well, the process, I'll give you the broad process. Basically, you dig it up out of the ground. But true professional, this bloke. You dig them up out of the ground. Now, the thing is, too, they're in really small quantities, right? Yeah. So it's like 2%. So it's not like you scoop up a handful of dirt and there's 80% iron ore, right? It's like 2%. So you've got to put it through a series of processes which are really heavily toxic in chemicals to draw out the neodymium right at the end. Yeah, so you've got to get rid of this and you go, righto, we put that back at the start, right, do it again, and there's all these toxic processes. Then you get the neodymium at the end. Then you've got to process it into a product and send it.
Yeah.
Right? So the problem has been with rare earths and with mining generally is that it's really toxic. And so when we all got environmental, they went, okay, well, let's do it in China.
Yeah, China can do it.
Let them pollute all the rivers. They don't care, And China realised that there was a strategic it was a strategic asset, right? Because they looked at it and said, all of today's products, right? iPads, laptops, iPhones, jets, military stuff, all depends on rare earths.
Literally, I was reading that article you shared in the week that was, and there's almost no components in the military that doesn't rely on this stuff.
That's right.
The US military.
Yeah.
So it's like, why are you picking a fight with them?
Well, this is
when you need that.
Well,
but then China needs the US to buy it too.
Well, that's the interdependence. But the issue is, Tom, all the economists that 50 years ago were going, oh, free trade. And it's like, now we don't even make our own ships, our own weapons. How are we supposed to defend ourselves? Right? And this is the serious part of it. Like I said to you, in 2011, I read reports from the European Union that were saying, guys, this is a bit of a shit show going on here. We need to do something, right? Mm-hmm. And here we are 14 years later and they're going, oh, okay, we better do something.
But didn't China do this to Japan?
They
threatened to cut them off? Or?
Yeah, in 2011, and at least the Japanese were smart enough to say, let's stockpile. But the Americans, you see, they didn't want to have all that wasted, quote unquote, money sitting on the dock with neodymium preosmium, like all the rare earths. Instead of having them sitting there.
You're making words up.
No, mate, that's the way. That's the words they are.
They all got really drunk and took turns at picking.
Yeah. What do we call this one? Call this one dysprosium. It's like, yeah, that's cool. Have we got all the vowels in there?
Yeah, but I mean, at least with Japan, they started stockpiling after the fact, right? So
yes, but they had the wisdom to say, well, let's buy more rare earths and stockpile it,
We're not
whereas the
gonna get in this
Americans
position
didn't.
again.
yeah. So what's the impact? So China basically turned down export back to the US or the rest of the world.
Well, the other thing is too, on Wednesday or Thursday, I think it was Thursday, I didn't put it in, but the Chinese said to the Koreans, you're not to export anything that we've given you with rare earths in it to the US.
Mm.
Do you know what I mean? That's like me selling you a product and then saying, Jacob, you can't send it to your friends. It's, like, this is what I'm saying. This week we're getting really to the pointy end where things are starting to get a bit nasty. And so, again, this is the way history works, right? Something's going to break somewhere and it's going to get a bit ugly. And, rare earths is potential because the Chinese realise that they've got a lockhold on that. The West have said, we know that they've got a lockhold on it and we've got to really boost it up really quickly. But again, if you'd say we're going to do a rare earth mine and a processing, it's like, good, that'll be 10 years. That's why Donald Trump is saying get rid of all this regulation and stuff so we can just say, right, we want to build a factory, right, put it there. Oh, what about the blue-spotted dove? It's like, yep, right, put the factory in. That's what's, because what's going to happen is people are going to say, well, why can't I get a new laptop? And it's because of the blue-spotted dove. It's like, yeah, well, stuff the blue-spotted dove. I want my laptop.
Yeah, or the laptop's worth 10 grand.
Yeah, absolutely.
Well, you might be able to put your hand up, Jacob, and start cleaning some minerals.
There you go,
To help everyone out.
I basically nailed that process. Yeah. Clean the minerals.
It's pretty easy.
Yeah.
Clean them and then make the 900 pounds of rare earth required to build an F-35 fighter jet.
That's right.
And then fly it. Maybe we can do TMM minerals.
TMM jet.
It's like, oh, Jesus,
Anyway.
you blokes. It's like, where do you get meat from?
The banter's back. The banter's back.
Right.
All right, Shane Oliver. So the chart we've got on the screen here, sorry for everyone driving, is basically the impact of tariffs on global growth moving forward. And Blake, we've already kind of alluded to, we don't actually know what that looks like yet. When do you think we will?
What, in growth?
Yeah, when the tariffs will actually start to have impact. Would it be 3 months, 12 months?
Well, this is the difference between, in 1965 or 64, somewhere around there, the Cape ratio was, high-ish, about 27.
Yeah.
And it spent the next 16 years getting down to 5 in 1982, right? It bottomed, and then we had the bull market. Now, nominal GDP growth was actually quite good, right? Now, what I'm talking about there is nominal, which is we grew at 6%. Oh, cool. But inflation was at 4%.
Yeah,
and then you go, actually,
too.
so we really only grew 2%. That's what may happen in the future. So the price of everything goes up. That pushes nominal GDP up, but you're just paying more.
Yeah.
Right.
So actual growth's like 1 or 2.
Yeah. So that's where you've got to watch inflation, right? That's where you've got to watch inflation and say, what's the real growth rate, not the nominal growth rate, right? And that's where it gets a bit hard because you've got to see what the impact of the tariffs are, how much it changes prices. Coca-Cola the other day said they're raising their prices, right? And this is what we talked about in the tariff special, right? If you're Coke and you go, these suckers just love Coke, they're going to drink it at whatever price, you put your price up.
Yeah, why not?
Because they can take advantage of it.
What about Doritos?
Right.
That's Pepsi.
They're on track for $20 a bag.
Pepsi makes Doritos.
Steve's a magician.
We've moved from Doritos, I've got to tell you.
CC's?
We're on to Cheerios. The cheese. You know Cheezels? You guys know Cheezels?
You got plenty of money. What are you doing?
What? You just...
And we've moved from Woolworths to Aldi too, apparently.
You're right.
That's what my son said. So now I go to Aldi. There you go. This edition sponsored by Aldi.
Yeah, thanks, Aldi.
Anyway, global growth's going to go lower, and then it's going to be a shit show all over. And
that's actually the question.
Rather chaotic.
Is it easy to see real? Obviously, all the figures show nominal growth. How do we find real growth?
Well, you just take away the inflation.
Right.
So growth is at 5%. Yeah, inflation's 3%. Okay, so we're growing at 2%.
Got it. Right.
That's the way it works. So with stock market returns, like the RBA did the study in 2019 and said the average return is 6%, The geometric return, right, which is the one we bang on about, and the real one is, the average return is 8. The geometric return is really 6, and inflation is 4.1. So your real return is 1.9. Okay, 36 years to double your money. It's not exactly like, oh yeah, I'm rolling in it. That's why we say, why would you buy and hold for 1.9%? Real. Or let's be generous, 3%.
Yeah.
Right? It's not, it's not a lot of money in terms of making investment gains.
No, if you knew that was your path, you'd go, no thanks, I'll try something else.
Well, yeah. If it was 100 years, this is why we talk about bull and bear markets, right? Because you get if you get like you said, you get the 15 years, the latest 15 years, you 10 times your money, right? Whereas now, if you're back in 1965, well, you don't make anything for 15 years.
Timing the market, not time in the market.
Well, yeah, it is, but, it's not in the interest of the finance industry. Well, we've talked about that.
Yeah,
Righto.
yeah. Not again.
Thursday, what's going on here? So, I mean, essentially this is saying, all right, so what's happening at the minute is people are going, buy the dip, buy the dip, buy the dip. And what we're saying is, when the CAPE ratio is this high, look back.
Yes.
And go, when the CAPE ratio is this high and the markets fell this much, when were the times that it's recovered within the next, let's just say 90 days? I mean, this is first 74 trading days.
Yeah, yeah. Well, what I'm trying to point out here is when these situations happen where the market goes down, right, 10 or 15%, right, and people go, okay, everyone suddenly gets a statistic to say, here's why you should buy more stocks now because it's gone down 15%, right? Oh, look, and what I'm saying here is that worst performance through the first 74 trading days. Okay, why not 75? Why not 52?
Because we know we cherry-pick data with these things.
That's the point, Tom. That's the point, right? Because what I'm trying to show there is when you look at it, everyone puts this data forward generally to be bullish.
Yes.
Right? To, as Tom said before, buy the dip.
Yep.
And what I'm saying is, okay, there's always occasions where it didn't work, right? So it's a little bit like, oh, it works 70% of the time. Okay, tell me the 30% when it didn't work and let me look at another set of statistics as to why it didn't work on those times. And what I'm saying is you generally go back and go, yeah, the CAPE ratio was really high, right? So it's sort of like saying, oh, if you buy when it's down 10%, you make lots of money, except in 2008 when it crashed 50%. Oh, okay. And in 1931. Oh, okay. And in 2002. Oh, okay. Why were they different? Because the CAPE ratio was really high.
Yeah, the market's really expensive.
Yeah, it was a 15-year bull market.
Yeah.
Right, and it came to an end.
Point being, scrutinise the times where it didn't work. What's the common denominator?
Now.
What we found
exactly
in relation to the tools we use to analyse.
Exactly.
Is CAPE.
Buy the dip works until it doesn't. And when it doesn't, it can be really ugly because for young guys or inexperienced investors, you've bought the dip the last 5 years and it just keeps working.
Yeah.
Right? And then it doesn't work. But you don't know that, right? Because you haven't experienced it and you don't have the knowledge of it. And that's why I say, that's why we teach people about market history, because it's absolutely important to see these flags and go, I think I might need to be a little bit cautious here.
Well, what I've kind of come to realise is asset allocation and rebalancing is kind of the difference between, taking time to get back to where you were or really making a lot of money out of really dark times.
Absolutely.
There's actually a huge opportunity in a market crash.
Yes.
As frustrating and as much as many people get burned.
You need one good recession. That's always my slogan, right? And the reason why is, again, 2009. You've made 10 times your money, right? Every time, 1982, 16% compound per year for 18 years. Right, 1942 or something. You make lots of money, but you've got to wait for it to be cheap. But when it is cheap, then you jump in.
Yeah. If you're all in beforehand, then you're kind of stuffed.
Well, remember we were talking at the coffee shop and we were saying, if you buy a stock at $1 and you 10 times it, right? Now, let's say it's $13, right? Then the market crashes 50%. It's back down to $6, right? Somewhere around there. You bought it $1, right? So you're still doing really, really well, right? And then if you can survive that and it goes back up to $24 in the next bull market, then it crashes 50%. Then it goes down to 12, right? So, but you're still, what I'm saying is if you bought at 1, even after 2 enormous crashes, you're still doing well, right? Because you bought cheaply. If you buy expensive, it's just a lot less profitable because you're paying too much for something, right? And it goes down 50%. Now you need 100% to get back to where you were, right? Before you even start back to your old position of being where it was expensive. Right, and that's why it's really important, because if you start investing in 2000, I'm talking about the US, to now you've made 5% per year. If you invested in 2009 when the Cape was 13, you've made like 14.5% per year. So this is the point about it's the rate at which you compound, not the time. Right, you might have a bigger figure from 2000 in terms of monetary figures. But in terms of return on equity or profit, you've done a lot better since 2009.
Well,
right?
We won't obviously name exact names, but we've worked with people in the past that have gone, I've just sold my house. Let's just work out and this leads on to Aussie Homes and what we're talking about next. But let's work out the yield on said house, and it's worked out to be 3 to 4%.
Yeah.
But the figure is about 300 or 400,000. So you look at it and go, shit, I've made 400 grand. And when you do the maths, it's actually 4% a year. And it's crap.
It's not saying the dollar amount is bad.
No.
But it's when you look at the profit as a percentage, you go, okay, well, that's not as good as I thought it was.
Exactly, yeah.
Right? So
Australian homes are less affordable. Who'd have thought that? But what's the ratio? Medium capital city house price to average income's now at 12 times.
That's insane. The long-term average is about 4.
Yeah.
Right.
And it doesn't look like it's going down to 4 anytime.
No. Well, yeah. That's what I mean. It might go down to 4, but it might take 20 years. But have a look at it. Have a look at that chart from 2000, right? And tell me where John Howard brought in the capital gains tax and the negative gearing stuff.
You can almost just put an exact pin mark on it, can't you?
But there was an event, and we talked about this in our property specials, there was an event with the Asian financial crisis which flooded countries with money, countries like Australia, England, the USA, Canada and New Zealand, right? Because we've got open markets. This is part of a larger problem, which is what we've got now.
We let anyone buy a property here.
Well, not necessarily anybody buying, Tom. It's a structural position which Donald Trump has highlighted by saying all you people are exporting to us and you're flooding our markets with cheap goods and cheap money. When you hit a market with cheap money, meaning low interest rates, people speculate. So this is why we've got property bubbles and stock market bubbles and bloody Bitcoin bubbles, because there's all this cheap money around which people are speculating with. Right? And it's blowing up asset prices.
Property has been like so lucrative for so long.
Absolutely.
People, capital gains, exemptions, negative gearing.
But it's, again, Tom, as we pointed out, I think a couple of weeks ago, Australia's debt levels are astronomical.
Yeah.
Right? We've been growing debt at 7.5% per year. Right? Compound. So what you don't realise is, or what I've been trying to get to people to think about is, when the GDP is 3%, means GDP is production of goods and services, right? We've been growing that at 3%, but debt has been growing at 7.5%. So what I'm trying to explain to people is that 4.5 gap is in speculation, right? And that's why property prices are absolutely through the roof, because a lot of wealthy people can just continue buying property, right? And it's worked for 25 years. But structurally, it can't go on forever. And that's what we've got going on now with the tariffs, right? There's a talk, and I meant to mention this earlier. There's talk this week where they're talking about delisting the Chinese ADRs, right? ADRs are foreign companies that list in the United States, right? So BHP has an ADR in the US on the New York Stock Exchange, right? You want to list there because that's the biggest, most fluid market where people will buy your stock, okay? That's where a lot of Chinese have listed in New York, right? Now, here's the rub. The Chinese companies have said, we're not going to comply with your audit rules. So in other words, it's just bullshit opaque stuff. You don't know what's going on, right? But investors have been buying them because of the belief in the Chinese economy and stuff. But now they're talking about delisting them, right? That's a really, really serious issue, right? This is what I'm saying. There's so many things out there that you look at and go, I can tell you as an old man, you're looking at it going, man, this is a red flag.
It makes the stock worthless. You can't sell out.
Well, you can sell out, Jacob, but, who's now...
Who wants to buy it?
Exactly.
Well, who wants to buy it? But the question is, at what price?
Well, yeah, it'll be worth nothing.
And this is what I'm saying. You've got
stocks.
You've got tariffs. You've got rare earths issues, right? You've got trade wars going on. There's just so much. And we got a 15-year historical bull market. You've got stuff like cryptocurrencies going on, right? You just look at it and go, man, this is a really volatile time. And that's why we've been saying to people, you got to start thinking about hedging your portfolio or, doing things to say, how can I protect myself if there's going to be this high volatility?
Yeah, exactly. And then, that kind of also links to the Aussie Homes thing, where if you've always been in property, maybe take some money off the table at some point and think about something else. But just to finish on that, there's obviously Libs versus Labor at the minute and all the policies they're bringing in for whoever's elected in May. The policies that they're talking about are all mostly to help first home buyers, but they're also, in my opinion anyway, that's going to increase house prices even more. Because you've got access to 5% with Labor, you've got access to your superannuation with the Libs, and it's just going to boost
make
prices.
Demand. Yeah.
So
but it's like we said, who wants to say I want lower house prices?
Well,
yeah. Everyone that owns a house doesn't want lower house prices.
Yeah. Anyone trying to buy one wants lower.
Yeah. But you got 60% of people either own their own home or have a mortgage. Okay, so 60% are saying, I don't want lower house prices, thanks very much.
Yeah.
Right? Who cares about young people? The oldies are saying, I want to sell it at 3 million, move to the Gold Coast and, buy an apartment for $1 million and make 2 million capital gains and happy days.
Well, the oldies are buying houses for their kids anyway. So they also want that to keep going up.
Absolutely.
Anyway, we've got property specials on that. But bonus section. So America, this is basically the symbiotic relationship between America and China, and they need each other.
Yep.
Which I think you've got an interesting take on. So feel free to kick off on that.
Well, just all I'm trying to show there is, and this, I think it was this week, Donald Trump said they're going to exempt tariffs on smartphones and computers and stuff, right? So this is where you start to now get a bit more specific of, what do you mean we can't get smartphones? And it's like, they're all made in China, dude. And it's like, okay, we might exempt them from the tariff, right? Now, Apple yesterday came out and said they're going to move iPhone production to India and they're going to start in 2026, right? Well, that ain't that far away. So what I'm saying is, again, what we said only 2 months ago, what you're going to find is, now imagine you hold stock in Apple and Apple says, listen, we're going to have to now start spending billions of dollars to move stuff, right? Oh, okay. So, but cool. We'll still be making $10 per iPhone. No, we won't be making $10 per iPhone. Oh, okay, we'll be making 4. Oh, okay, well, that means Apple's not worth $300, it's worth, 175. Okay, and the current price is 264. It's like, okay, Apple's now overvalued.
Or Apple increases their prices.
Hence the reason why Warren Buffett probably sold an absolute bucket load a few months ago, because he can see this coming. They're going to have to spend, all companies are, they're going to have to reinvigorate their spending away from China into Thailand, Cambodia, Korea, America, Japan, right? And that takes away a heap of the profit, right? Because the Americans, companies have been really profitable because they haven't had to spend a lot of CapEx in America, right? You can build stuff in China for, 20 times less. Mm-hmm. Well, that's over.
It kind of doesn't make sense to move to India, though, because they're part of BRICS anyway.
Yeah, but the BRICS is bullshit, Jacob. Look, this idea they're all friends. India has put tariffs on China. Brazil has put tariffs on China. They're all doing it. So this idea that we're the BRICS was a term coined by a bloody hedge fund manager.
Oh, really?
Yeah. It wasn't. It's not an official title.
Oh.
So it's basically just garbage when you dig into it. All of these countries do this thing where they go, yeah, I've got some new friends, Tom and Jacob. And then Tom says, I want to export my stuff. And I go, oh, no, that's not the way it works, Tom. I want to export my stuff. Right? Oh, well, Tom's not really my friend. Oh, well, stuff Tom. Right? And that's what happens, right? Then they go running.
TMM, fair weather.
And then they go, yeah, but it is. And then they go running back to the US and go, hey, we want to make a deal.
Yeah.
Right?
Yeah, okay.
So, lesson of the week.
All right, we kind of touched on this a little bit before, right?
We did.
It's a chart. What happens when you buy assets down 80%? Short version is you get really, really outstanding returns.
Yeah.
So, if you're not already, subscribe to the week that was, because you'll be able to see this document, see the charts that we're talking to. But, there's one here. The average 8-year nominal returns when buying a country down since 1970s, for example, if it's down 90%, 156%. Is the average.
Which is not a bad return.
No, but to your point before, right? If you had bought that country to $1 and it drops to 10 cents and it goes up 156%, you're still down.
Yeah, you're at 25 cents. Woohoo!
Yeah. Correct. Whereas if you'd bought at 10 cents,
that's right.
It's a different story.
Yeah. So, well, to give you an example, I hold some rare earth stocks, right?
Really?
Yeah, and I've held them for years,
Neodymium.
right? You'd be sarcastic.
Neodymium.
Yes, and I held them for years, right? Now, one stock I bought at $2 and it's been like 40 cents, right? I'm like down 80% or something, right? But this week when China said, we're going to hold up, we're holding up on the rare earths, this stock and a couple of the others went up about 40%. Mm-hmm. Right? Now you're looking at 40%.
Now you're down
right?
60%.
Right? It's like another 500 and I'll be killing this, baby. That's your point, right?
Yeah.
This is why we say to people, for Christ's sake, don't just buy at any time. Right? Work out the value, work out the earnings yield. It ain't that hard, right? But you just got to be aware of it, and the mathematics of it.
Yeah. And have a system. Don't ape in.
And don't buy rare earth stocks at the peak, folks.
Thanks, Mr. Moriarty. Peanut Boy, Elon, he's getting out of Doge, back into Tesla. Their earnings are down by, what are
a lot.
Another Steve told you so.
Something. But I mean, yeah, he's moving back into business as usual, or he's trying to, but the next 12, 24 months will probably be quite hard for him to redevelop his, what's the word?
The brand.
Yeah, his own brand.
Yeah. As I said before, I'm tracking Elon because every market cycle has a god, right? And then the god falters. And Elon, I think, is this cycle, right? He's faltered by moving with Donald Trump, and now people have really turned on him. And the problem is, once the people see the real Elon, then they're going to go, you know what? I don't want to buy one of these cars. And that's what's going on. And that's why he suddenly said, I'll be out of Doge in May. And my line of thinking is, yeah, well, let me tell you, buddy, people have made their mind up that you're an asshole and it's too late for you to go back to Tesla and try and save it. Because there's a lot of people now who don't respect Elon, right? Now, he'll probably get saved with SpaceX and Twitter or X. But again, Chinese are outcompeting him on Teslas, right? Teslas look like old cars compared to what the Chinese are doing, right? He's going to lose the Chinese market because the Chinese are now, everything you see now about the Chinese market is homegrown stuff, right? Because the government have basically said, right, don't buy American products. Right? What's an American product? Tesla. Right? And the Chinese EVs are killing him. That's why the EV market's growing and Tesla's shrinking. It's like, that's not a good place to be.
Yeah, it'll be interesting to watch because 24 months ago, Tesla were number 2 in China. So it'd be good to see where they go over the next 12 months when they drop the rankings.
But I just think he's going to really struggle. And the PE is still like 118 or, like 170 or something. So
watch this space.
I think
we're done, fellas. Good to have you back, Tom.
Yeah, good to be back.
We'll see you all next week. Cheers.
Cheers, folks.
As always, remember, we don't provide financial advice.